Let's just talk about what's ahead for the sector, especially with the prospect of higher rates for longer. And for that, we'll bring in Gerard Cassidy, RBC Capital Analyst, head of U.S. Bank Equity Strategy. Things are going okay for your group so far this year. What are you most worried about?
David, the biggest risk for the banks, as it's always been, is credit quality. If this U.S. economy does not have a soft landing, the stocks are certainly pricing in a soft landing. We believe a soft landing is coming. And if it doesn't happen and we have a hard landing, that would be the biggest risk, David, for the stocks.
Yeah. You don't see that happening, do you?
No, sir. We do not. The soft landing, you look at the employment data, you look at the wealth of the country, you look at the expansion in the manufacturing space, with the onshoring of America. There's a lot of positive trends in the U.S. economy. And so we're in the camp that we are likely to see a soft landing. And some of the early indicators are suggesting that's what's going to happen.
Megan was just talking about this hearing on Capitol Hill, not the sexiest on the discount window, but it does make me wonder, Gerard, whether there is an increased liquidity risk from the banks, something that was learned the hard way back in last March, whether that was a one-off or whether this is a legitimate topic that the discount window or other methods should be able to help with in the future.
When you think about the discount window, Sarah, the Fed was created to be the lender of last resort. And as much as the politicians, bureaucrats, and regulators want the banks to be tapping into this window just as a way of forming up, a trend, it has that stigma attached to it, and the banks don't want to do it. And they don't need to do it, of course. There's plenty of liquidity in the system. But as you pointed out, in March of last year, when we had March Madness, as we refer to it, when Silicon Valley and Signature Banks failed, and then, of course, First Republic in May, there was a liquidity problem for some of the banks at that time. Obviously, those banks, very severe, and put them out of business. But what's interesting is, the deposit flows of all the smaller banks. There was outflows around March of 23, and we're almost back now for the smaller banks at deposit levels where we were before March Madness hit. So there really isn't a liquidity problem today. But I understand they want to, grease the track so that when there is a liquidity problem, the banks will be able to use that window. And they're all set up to do it. They just don't want to have the stigma of going in and testing it on a regular basis.
Hey, Gerard, we've seen some upgrades of at least some of the investment banks. I think you have holds on Morgan Stanley and Goldman. Are you a doubter that any return of capital markets activity is going to be robust?
Carl, it's a really good question, and we're on the fence, and maybe we're trying to be too cute to see a little better evidence that the capital markets businesses will be coming back. But if people are looking for pure plays on the expectation that the IPO markets come back, advisory business, more mergers and acquisitions come on the scene, those two names are certainly ways of playing it, as well as the universal banks. We have rated outperform Bank of America and JP Morgan, and part of the reason is that they are going to benefit from that as well. But you're right, a pure play would be those two names, and we're just trying to figure out maybe when is the best time to jump on board.